In 2020, I took it upon myself to try an experiment where I would trade and manage my account similar to like a hedge fund. To give a little backstory, when I was 29 years old, I reached a point where I call it the career financial purgatory. It's the zone between $100,000 and $1 million where, although you're making pretty good money, when you account for taxes and an increase in lifestyle, you kind of feel like you're still stuck on the hamster wheel. That's exactly how I felt at the onset of COVID in 2020. So to fix this issue, I knew I had to do something where I could create passive income that was also scalable. To solve this problem, I took it upon myself and thought it was a bright idea to begin an investing account where I would trade like a hedge fund. Now, to set some context for this, my objective was to get a 15% plus return on average each year. And to be very clear, I kept the majority of my investment account passively indexed as I didn't want to reinvent the wheel. I wanted to create a smaller account that would do a long strategy that looked at undervalued stocks. And then on top of that long strategy, I wanted to take an even smaller account and trade and invest in derivative products that could boost the return. So in this video, I'm going to go over what my experience was, what the results were, and why I don't currently invest in my account this way anymore. So let's start with the challenges that I faced. Keep in mind that I actually had no real formal investing experience or trading experience. I just read a couple of books, one of which was Market Wizards, Trade Your Way to Financial Freedom, and the little book that beats the market. And I figured, well, I had to start somewhere, so why not just start with practical application and practice? In all the books that I had read, there was a common theme that the investors that were super successful over a long period of time had to go through this process of blowing up multiple accounts and going through these emotional turmoils to finally get good. So I figured, why not just jump off the porch, go into the deep end, and start managing the account? So my first challenge was the deep learning curve. I severely underestimated how challenging it was to invest an account this way, and also the emotional stress that it puts on you. I've experienced some pretty hard things in my life. Nothing compared to how difficult and emotionally taxing this was. Let me give you an example. So when you're going through the process of trying to manage your account like a hedge fund, there's severe highs and severe lows. And never in my life had money and lows affected me this much. I remember there were days where I'd have bad trading days or bad investments, and I would just sit in my room for hours, not eat for an entire day. And it wasn't necessarily about the money. It was more so about the amount of work that I was putting in, and it felt like I was just getting nowhere. Challenge number 2 is the cost. At first, I didn't realize that running a trading account like a hedge fund is literally running a business. And there were a lot of costs associated with this business. You have to pay for fees to the exchange to get the data that you need. There's increased cost in transaction. All of these costs added up to about anywhere between $500 to $1,000 a month just to maintain the account. The next challenge that I ran into was just experience and screen time. I underestimated the amount of time that it took to actually get good. One of the biggest challenges that I ran into is the reporting and the administration. I severely underestimated this as well. When you have a lot of transactions going on, you have to account for all of the transactions, and you need to have a strict journaling process and a process to know if you're actually outperforming the market, what's working, what's not working. This reporting process in itself is a huge task. Trading like a hedge fund was definitely a 7-day-a-week job. Let me give you an idea of what my week would look like in just the reporting and accounting aspect. So every single day, Monday through Friday, the market's open. You would trade and invest in different products in the market. Some are short-term, some are long-term. After the week is gone, on the weekend, you would go back, go through your journals, go through all of your transactions that you did, and you would study what went right and what went wrong. This was a huge administrative burden and took a lot of time. During this period of the 3 years, I found that I really had no time for recreational activities, as all day during the day I was focused on the market, and then on the weekend I was focused on reporting my trades, getting all of my returns in order, and trying to keep track. So now let's talk about which strategies that I used. So one of the books that I read was A Little Book That Beats the Market by Joel Greenblatt. I decided to try to use this strategy to identify undervalued stocks that I could buy and outperform the market over time. Now, going back to the emotional distress stage that I talked about in the challenges, one of the things that Joel Greenblatt mentions in the book is that even though he gives you the strategy, most people would not be able to successfully implement this strategy because they wouldn't have the emotional discipline and stability to implement it exactly as he laid out. And this was absolutely true. I would identify the companies that Joel Greenblatt would say were good for undervalued investments, but then I would go and for whatever reason, I would detour from the strategy. I would either not pick the stocks that he said and pick other stocks that I think were better. I would look at the financials and study and then decide that this stock was better than this stock. And overall, I created my own morphed version of this strategy, which worked, but it didn't work as well as I would want it. Next, for the derivative strategy, I used a strategy that I actually had received from a professional trader. Same story. It wasn't that the strategies didn't work, but I found that maintaining the emotional discipline to implement the strategy consistently and also be able to sit on your hands on days you're not supposed to trade the strategy was more difficult than I anticipated. The derivative strategy especially was very volatile and required a ton of emotional discipline. So now, what were the results of this experiment over the 3 years that I did it? I went back through all of my old statements, all of my old tax returns, and I used AI to help me assist getting this report together. If you want the AI prompts that I use to help me put these reports together, I'm going to include a link in the description where you can download my AI prompts and test them out on your own account. But going to the results. So if you were to simulate investing $100,000 at the time I started investing to the time I stopped with this experiment, it would grow to a little over $38,000. Over that same period, if you were to invest in the S&P 500, that would grow to a little over $50,000. And I want to expand on this a little bit of why I underperformed the market and some of the lessons that I learned. When you are implementing the strategy, you have to accept losses in the first beginning years. Back to Market Wizards, just about every successful investor that is featured in the book, when you read their story, they blow up sometimes multiple accounts in order to build up their strategy, the research, and the emotional discipline to handle the ups and downs of the market. So although I underperformed, much of the underperformance actually wasn't in individual stock picking. It was in the options and future strategies, as you'll see here. Now, the option strategies actually turned around, but one of the things I found in the option strategy was that the emotional burden that it put on my life, I didn't think was worth the returns. And what I mean by this is running that option strategy required a ton of oversight, and it required these periods of really high highs where you're doing really good and then really low lows where the market is just brutal to you. And you have to have the discipline that when the market's brutal to you, you can take losses and not melt down. I often found that my strategy worked pretty good. And as you'll see here, I had over a 60% win rate on all of my trades. But the one thing that held back the strategy from outperforming the market is that my losses would be very big losses that wiped out a lot of consistent good days, which was part of this huge learning curve that it takes to be able to manage an account like this. Other than the underperformance of the market, when I went back and looked at the risk of my account over this period, as you'll see here, the account took on a ton of risk compared to just investing in the market. So this was a double negative. Not only did it underperform, but it underperformed while taking on a bunch of risk. As a matter of fact, when I went back and looked at the results in 2021, I actually had to leverage $1.4 million just to get a $40,000 return, which equated to about a 4% real return on the money that I was leveraging. We were in a massive bull market and I got a $40,000 real return as far as real dollars that I can put in my pocket. But at the same time, I had to leverage $1.4 million. This just didn't make sense from a risk return perspective, which is one of the big problems that I have implementing a strategy like this. So when you combine the learning curve, the time commitment, and also the amount of risk that you have to take, I felt that this wasn't the most efficient way for me to invest. And this is why I no longer invest this way. Now, to summarize, would I do this again? And what are my thoughts after investing like this for 3 years? I would absolutely do this again. And here's why. I learned so much investing this way and implementing these strategies. And any type of money lost or money in underperformance, I take it as the price of tuition. Sometimes you have to just take some losses and try some different things, but on the other side of it, you have a ton of lessons learned. I had many hours of screen time just looking at the markets, understanding how markets move. I understood economics at a much higher level, just being around these different market events, looking into how the Federal Reserve affects the stock market, how I could take advantage of it, that in the future, if this were to ever happen again, I would be much more prepared to handle a bull market of that type of magnitude. The other thing I learned was emotional discipline and risk management. When you feel the sting of losing money and how hard it is to make it back in the ups and lows, you will learn how to manage risk, and you also have a greater appreciation of risk management. This is the number one key to being successful in any investment portfolio, is having risk management and having discipline. I also understand that financial markets are extremely challenging. It would be completely unrealistic for me to think that I can go into something as challenging as the market and see immediate success. Even though I no longer manage my investment portfolio this way, this was an opportunity to learn markets, enter the industry, and also just get my feet wet and try different things. If you are interested in learning the investment approach and strategy that I use now, make sure you visit the video that I'll link above. And also, if you're interested in learning more about alternative investment, make sure you subscribe to AltShift. AltShift is a weekly newsletter where I give investment tips and insights delivered to your mailbox weekly.